This chapter will discuss international monetary systems. We'll begin with discussing exchange rate systems in general. Then we'll talk about the history of international exchange rate systems, beginning with the gold standard and then moving on to the Bretton Woods Agreement and the Smithsonian Agreement, and finally to the international floating system, which we have now. We will then discuss the European Union, its creation, and what was expected to happen at the start. We'll talk more about the actual state of things today when we meet back again in class. And finally, we'll talk about how currency crises in one country can spread to other countries through international trade. So the two broad forms of international exchange systems that we can have are a free float or a managed or dirty float. With a free float, there is no government intervention. It's basically market forces determining the supply and demand, and hence the exchange rates. So as economic parameters, namely interest rates, inflation, economic growth, political risk, as those types of things change, then market participants would adjust their expectations about their current and future needs for a currency, and thus supply and demand would be determined in that way. So there is no intervention by central banks. There's no one country going and buying up another country's currency in order to change exchange rates or manipulate them or anything like that. It's purely a supply and demand driven system. A managed or dirty float does involve government intervention. And there's three basic kinds. There's smoothing of daily fluctuations, where the goal is to preserve an orderly pattern of exchange rate changes and ease transitions from one exchange rate to another. So this is just the central bank intervening as far as buying or selling a different currency in order to help smooth out exchange rate fluctuations and move from one rate to the next almost on a daily basis, kind of trying to make things more predictable in the short term. Then there's leaning against the wind, which involves a little bit more intervention, and this is done to prevent or moderate short or medium term fluctuations caused by shocks like changes in oil prices, natural disasters, wars, those kinds of things. So this would be a little bit more of an intervention that's going to be going on if you don't feel, not really letting an exchange rate settle based to where it should be on supply and demand as quickly as you would expect, saying maybe we think this is something that's only going to last a month or two, so we'll, artificially keep the exchange rates at this value for that month or two and just wait for that to end, and then they'll go back to more of a supply and demand driven level, something like that. So this is more of an intervention than the smoothing fluctuations. And then finally, the most strict would be an unofficial peg, which is basically a commitment to maintain exchange rates at a specific level without actually coming right out and announcing that level. Now, free float and dirty float can be used in a target zone agreement, as well as a fixed rate system and a hybrid system. So in a target zone agreement, market forces are constrained to an upper and lower range of exchange rates. So this is saying supply and demand will basically set the exchange rates, but we want to keep them within a relatively predictable set of boundaries just to, promote more international trade. So this would basically be where countries agree to adopt economic policies that will cause them to maintain exchange rates within a specific range. The goal is to minimize exchange rate volatility and therefore lead to more stability for the participating countries. So this is something that you might see between countries that do a lot of trade together. They'll try to align their debt policy, their inflation policy, those kinds of things, in order to ensure that their exchange rates fall within a specific set of bounds. Now, a fixed rate system would be where the government maintains specific exchange rates and those are announced. And that's not necessarily, just them creating the economic policies that will maintain these exchange rates. This is them actually going out and buying and selling the other currency in order to maintain that specific exchange rate. So in a fixed rate system, central banks will revalue or devalue their currencies when the exchange rates diverge too much from a pre-specified and announced target. A hybrid system is kind of like what we have now, where there are target zone agreements, there are specific fixed rate or pegged systems, and then there are some that are just completely free floating off on their own, not worrying about, exactly what their trading partners are doing, just worrying specifically about their own economies. So we're going to look now into the history of various exchange rate systems that have existed. We're going to start with the classical gold standard. So in this example, we see U.S. prices are falling. So U.S. prices fall. So if the price in the U.S. falls, then U.S. exports would rise because it's cheaper to produce things here, and imports would fall because we have less money. So as a result of the exports rising, there would be a U.S. balance of payment surplus. So we would have more exports. And how are they paying for that? Well, this is the gold standard, so they're paying for it by gold flowing into the U.S. So as the amount of gold in the U.S. would increase, then the U.S. money supply would increase. U.S. prices would then rise and then bring us back into the system. So then U.S. exports would fall and imports would rise, and we'd cycle back through this situation. So with the balance of payment surplus, there's gold inflow, which leads to higher prices, which then leads to a reduction in the surplus and vice versa. So what exactly was the gold standard? It was fixed prices of a currency in terms of a specific amount of gold. This was done to promote economic stability. It had a benefit for rapid expansion of international trade because there were stable exchange rates and therefore predictable exchange rates, which meant that prices were predictable. So it allowed for a more free flow of labor and capital, and hence economic growth around the world. Problems with this, there were major depressions in the 1880s, which then spread from one country to another, and all these countries are linked because of, the gold standard. Other issues that arose, there were these things called bugger thy neighbor devaluations, where one country would specifically try to devalue their currency in order to maintain competitiveness, which would then lead to a trade war. Because if we saw here, anytime your currency dropped in value, your exports would rise. Well, if your exports rise, then, you're producing more, so there's more demand. And then your economy does a little bit better. So they were trying to specifically devalue their currencies consistently. And when everyone does that, the system ends up falling apart. In 1931, England departed from the gold standard because it had gotten to a point where there were completely unrealistic exchange rates because everyone just keeps devaluing and doing all kinds of crazy stuff like this. And we end in 1944 because we lead to, this is at one point only going on with the Allies, and World War II, all that kind of stuff. So in 1946, the Bretton Woods system is created, and this holds from 1946 to around 1971. The Allied nations agreed to maintain a fixed exchange rate between gold and the dollar, which was maintained specifically through central bank intervention. So this is a fixed rate system where the central banks are actually going out and buying or selling the other currencies in order to maintain their value relative to the dollar, and the dollar is doing that relative to gold. It was named after the Allied Conference in New Hampshire. It was in Bretton Woods, New Hampshire. And it was held in 1944 and called to avoid future devaluations, these bugger thy neighbor devaluations that we were talking about. 21 countries were involved, and this fixed exchange rate was $1 to 1/35 of an ounce of gold. And then exchange rates were set relative to the dollar, and those rates were supposedly supposed to fluctuate only by 1%. This also at the same time created the IMF, which is the International Monetary Fund. Its goal was to promote monetary stability and oversee exchange rate policies for member countries. It also acted as a lender of last resort and advised the developing economies, which after World War II is, pretty much everyone, because everyone's still sort of recovering from the war. Then there's the World Bank, which was in charge of post-war reconstruction loans. It was initially known as the International Bank of Reconstruction and Development and was set up to lend money to countries to recover their infrastructure after World War II. Now, the creation of these two, the IMF and the World Bank, leads to issues of the moral hazard problem. Countries may not, they may feel that they can have irresponsible debt policies, so too much debt relative to GDP, and not have to worry about not being able to repay their loans because they believe that the IMF will step in to bail them out. So we will talk about this current situation with Greece and doing that, and the idea of defaulting on sovereign debt and all of that when we meet in class. But just know that the creation of the IMF and the World Bank did introduce a moral hazard type problem into this system. Problems with the Bretton Woods system: only the U.S. and Japan actually maintained their par values for, relative to gold, or in Japan's case, relative to the dollar, as they said they would. 12 countries devalued their currencies more than 30% against the dollar. Remember, there's only 21 countries involved here. 4 countries entirely revalued their currencies, and 4 just walked away and allowed their currencies to float. A major problem within the U.S. was that you will notice that it ended in 1971. So in the midst of the Vietnam War, the U.S. decided to effectively print money, instead of raising taxes in order to finance the war. So it was a quantitative easing type situation. There was more currency, and more U.S. currency began circulating in the economy. And what happens when you increase the supply of something? Well, the value of it falls. They had to do this, so the increasing the supply of money means that the purchasing power of money is less, hence inflation. And they had to do this for political purposes, because you can't say, hey, I'm going to tax you more and institute a draft for, a war that isn't popular, so go off and have your sons die and pay us more taxes. No. So hence the quantitative easing that you saw at that point. Other countries couldn't accept the inflation that this fixed rate system ended up causing, and, it basically broke down. There was an attempt, the Smithsonian Agreement was like attempt to rehash it and try to save the system by the dollar devaluing to 1/38 of an ounce of gold as a result of this inflation kind of thing. And the other countries were supposed to be revalued in accordance with that, but it didn't last. Then we have the International Floating Exchange Rate System, which is 73 to present, basically saying that exchange rates are floating and they're offset by international differences in inflation. So real exchange rates will, in theory, stabilize given gradual changes in underlying conditions which affect trade. And hence, nominal exchange rates will stabilize if countries coordinate their monetary policies to achieve inflation rate convergence. So what is this basically saying here? Everything is going to be a free float kind of system, and supply and demand is going to set things. In theory, the float will facilitate more free trade, but in reality, currency volatility has increased over time due to non-monetary global shocks. A whole lot of wars, changes in oil supply, all of those kinds of things. All right, so this was talking about, the Allied nations or the entire global economy, looking at everything together. We're now going to turn to focus specifically just on Europe and the development of the European Union and the European monetary system. So the European monetary system was created in 1979 to foster European stability in Europe, or foster economic or monetary stability within Europe. In 1992, it was renamed the European Union, and it currently has 27 member countries. There's a link to the EU's website in English, is there. When it was created, the members established the European Currency Unit, the ECU, and it was a complete composite currency consisting of fixed amounts of the 12 members from the European community, the initial 12 who were going to be involved in there, which are the 12 major countries in Europe, and that the rate was set based on each country's relative strength, the strength of their economy. So Germany, being on the high side, Italy taking a slightly weaker position. The exchange rate mechanism held in place from 1979 to 1993. This is where it allowed each member state to determine a mutually agreed upon exchange rate, and then each rate was then denominated in a central ECU currency, which was more just like an accounting kind of currency. It wasn't something that you would actually be able to hold in your hand. And participants then agreed to try to maintain their cross-border exchange rates within a 15% margin of these cross-exchange rates. So this was basically a target zone system, which established cross-grid exchange rates within the member countries. By 1993, it had slipped to a two-tiered system, the strong versus the weak, relative to who were maintaining these cross-border exchange rates. In 1999, January 1st, 1999, the euro became a currency for the conversion rates, became a currency and conversion rates were locked in January 1st, 2002, the euro currency replaced all those other domestic currencies. So in 99, it was like a unit of account again that you would find online. And if we were going to transfer, money from one, convert money from one currency to another, it would be relative to euros. But you weren't necessarily using euros until 2002. And in order to do this, it had to comply with specific requirements. Government debt being less than 60% of GDP, budget deficit being less than 3% of GDP, and then specific inflation and interest rate boundaries. The theory was that this would lead to lower cross-border currency conversion costs because, there wouldn't be any. You would all be using the same currency. No exchange rate risk because there's no exchange rates because you're all in the same currency. Cross-border price comparisons would be unnecessary because you're all in the same currency. Catching on to a trend here, hopefully. If not, we have an issue. Facilitated flow of trade and capital, and increased European competitiveness when you're looking at Europe as a block. So you could now discuss the European economy and the American economy, the Chinese economy, the Russian economy, looking at those, huge units versus talking about the economies of Poland or Germany or Italy, which were smaller relative to those huge blocks. And we'll talk in class about how certain member countries, Greece, Italy, Spain, aren't really meeting these requirements and what exactly is going on there. Finally, how are economic crises transmitted from one country to another? Well, we live in a globalized economy, so everything is about imports and exports. Even things that we say we make in the U.S., well, there's parts that are coming from abroad, so everything is really interlinked. So the transitions mechanisms are via three means. The easiest one to think of is trade links. So as one economy contracts, its currency weakens, which then impacts its trading partners. So if you can buy less with your currency, that's going to have a trickle-down effect through the rest of the economies. Also links through the financial system. So distress in one market serves as a wake-up call and transmits fear into other neighboring economies as far as, thinking of the health of that economy. So we think about this in the U.S., it's really easy. We are effectively a union of different states, and you look at issues in one state affecting the economy in the rest of the country. I'll show you information where you can think back in the late 90s, there was a situation with the Asian tigers. So where I think it was Thailand went down first, and then all of the economies in that region started to crumble. And then, we've also seen this recently with regards to the European crisis. Debt policies, too much short-term debt is linked closely with the value of a currency because it's linked with the interest rates and hence the inflation rate when the country decides to, potentially do something about having too much debt and having interest rates be too high. So it could be transmitted that way. Also, that impact on that debt policy that could, if the government decides they can't fulfill government debt obligations, then that's going to trigger through from one country to another. Possible solutions, currency controls. So just abandon the free movement of capital and insulate countries' currency from speculative shocks. So this is more of a protectionist kind of argument. This would be stable, but the open markets channel savings from where it's most productive, or to where it's most productive, and the developing economies, who are the ones who actually need that foreign capital, are the ones that are also, kind of the most rickety and most likely to want to impose these currency controls to protect themselves. But if they protect themselves, then that means that they can't get currency in. So that's an issue. Free float, just let supply and demand solve everything. Or dollarization or currency boards. So dollarization is basically just saying, forget about having our own currency, we're going to use the dollar. And a currency board is specifically not using necessarily just the dollar, but pegging your currency to a specific group of different currencies, usually your most common trading partners. So the last fixed situation that we saw was China. It had a fixed exchange rate system. I think it undid that in 2010. There's some other currencies that definitely have, pegged exchange rates, though it's an unannounced kind of peg. And we'll talk about that in class when we meet again. Okay.